We're not quite done with the mid-cap pain. This is just a temporary relief, what you're saying. So what really has transpired in the mid-cap fall? Which are the stocks which are at a 52-week low? How much of the damage is already done with? Vivek?
Well, just have a look at how the markets have been performed. If you're talking about the Nifty is still, even after the last 2 days of pain, Nifty is still hovering around the 10,600, between the 10,500 to 10,700 mark is where the Nifty is. But, the real pain is actually, as we've been pointing out throughout, has been in the mid-cap and the small-cap space. The broader end of the markets are seeing severe sense of correction, and it's actually been a lot of portfolios that are getting hammered. Talk on the street is that, there is very little money to actually pour into fresh trades or fresh investments. And we've been trying to make sense of all the things that various analysts have spoken to us, the street, word on the street. We've been trying to make sense of all the different reasons that markets have come up with to actually explain the fall in the broader end of the market. The first thing that we heard towards the end of April was that the entire SEBI regulation on the mutual fund scheme rejig that basically said that if you've called yourself a mid-cap scheme, then most of your stocks should be in the mid-cap, and if it's a large cap, then most of the stocks should be in the large cap space with a certain market criteria. Of course, valuations are something that had run up in the last 2 years in the mid-cap and small-cap space. So valuation, again, it's a fundamental reason, and earnings really haven't caught up. Earnings disappoint, and this has been something that we've been talking about. We were all talking about a low base and earnings rebounding very sharply after that. That hasn't happened. The ASM measure, this was something that created a lot of panic, a lot of good quality stocks. Have a look at names like Dilip Bilcon, Rain Industries, HCG Graphite, all Avanti Fields, even for that matter. All of these stocks actually cracking very sharply on the back of the fact that they were introduced in the ASM. And lastly, you had a whole spate of auditors resigning. Some of these resignations were actually called for by SEBI because after a certain period, you really cannot have the same auditor again. Just have a look at how the markets have fallen. So Nifty and Bank Nifty in 2018 are actually in the green, which is actually hiding the kind of pain that you're seeing in the small cap space. So again, 21% fall is the small cap space that you're seeing. So that's almost a bear territory if you're talking about just the small cap index. The other thing to watch out for, and why is the Nifty actually outperforming, is the fact that a lot of people talk about index management, and you're seeing a very smart sectoral rotation that is happening, and this is something that is actually helping the index stay afloat. Just have a look at the stocks on the BSE. You've seen more than 100 stocks actually falling over 60% in 2018. Now this is again very, we are talking about 1,500 stocks, and over 100 stocks are falling over 60%. 40 to 60% again, not a small number by any chance, over 450, and again 20 to 40% over 600. So you've seen a sharp crack, which is why most of the portfolios that we are talking about are doing very poorly in 2018.
Now, where do we go from here? Is this the darkest dusk before the dawn, or the night is only going to get darker? That's anyone's guess, and frankly in the near term a lot would be dependent on the headlines which we will get at a global level, whether it is oil or trade war. But when we started the year, the view was that this will be a good year. Then everyone said that there would be a mild volatility, but nobody predicted this kind of an ugly U-turn, which in a sense has disappointed, surprised, and also has led to some excruciating pain in mid and small cap stocks. Taher, Badshah, how much more to go, and when do you think semblance and stability will come back to the markets?
Well, I think at one level, whatever has transpired in the last 2-3 months, especially in the mid-cap and the broader market, was in part self-inflicted, in the sense that we basically did overdo it in the first place in the upside, and therefore to that extent, to me it is still a bit of a cyclical or a correction or whatever a mean reversion kind of a thing that you would want to label it. We did extend the valuations, especially in the mid-cap space, beyond a particular level, and therefore to that extent the pain in the shorter run looks relatively more severe compared to what it should have otherwise been. But I think when we looking at now that space compared to what we were probably doing, say towards the end of calendar year 2017, we find we are going with a little more optimism, a little more constructive approach in terms of at least the larger mid caps. So let's say the top stocks beyond the top 100, the top 100 stocks beyond the top 100 of, so 100 to 200, let's say, that's the range where we believe that there are certain opportunities which are clearly materializing, and At least they are now at levels or valuations which are relatively more reasonable. I wouldn't say that they are cheap, but clearly they are at a level where they can be thought upon, investigated, probably even bought if need be. So I think they are coming into that zone. Can I say that about the whole of the large, mid and small cap basket? Probably not. So you have to probably dissect it a little bit. You have to kind of we are trying to find scattered opportunities in certain places. The opportunity set is getting a little more wider than what it was 6 months ago. So I think there are opportunities clearly coming about, but are they going to be really productive for you as an investment in the immediate 6 months? I don't think so. If you go in it with a view of 1 to 1.5 years, then I think there is money to be made from here on.
Taher, this morning there's all enthusiasm around IT. We've already seen how beautifully IT has panned out, and this is just barring Wipro. Currency clearly seems to be favoring them. We're already at 69. Who knows? We could go to 70 and beyond. And then you've got, globally as well, things looking up. There hasn't been a correction which has played out in FANG stocks. You've got just Accenture coming in yesterday, upping the revenue guidance and not just managing to beat the quarterly performance both on the top and the bottom line. How long do you think strength could remain with IT? And is right now the best time? Do you think the best is already played out? Does one now need to maybe partially book profits in IT?
I think, of course, the best time was 1 year ago when they were clearly contra ideas, and they were at valuations which were really compelling, and the growth trajectory since then has probably not altered significantly. Yes, Accenture has kind of consistently outperformed, and they've upped their guidance consistently over the last 2-3 quarters, but their mix is considerably different. Even within the digital, it is more of the new digital compared to the old digital, versus the way we traditionally understand digital from the context of Indian IT services. So can you do a direct 1:1 extrapolation and extend this from an Accenture perspective into Indian IT services? Probably not. But on its own, yes, they have a few drivers now kind of establishing themselves. Some part of it is probably looking like the fact that as borne out by Accenture's result, that North America is picking up, and that should partly help Indian IT companies also from that 5-6% growth that they've seen in North America over the last few quarters. So I think it should benefit. Will it happen to the same extent as what happened in Accenture? Probably difficult to say. Meanwhile, rupee remains favorable once again. Our analysis tells us that valuations are not cheap anymore. They are fair. Maybe they are not expensive, but can they significantly outperform from here on? Probably yes, because market is turning a little defensive, and maybe market will extend it into the near future. But it's not as juicy as what it used to probably be 6 months ago, maybe 12 months ago.
Okay, Taher, again I go back to that same point. When do you think markets will start differentiating between good stocks and bad stocks? 2017 was a rising tide. Everything went up. Anything which had a prefix mid cap or a suffix small cap, that stock went up. No logic, no rationale, lay low because you got a tip in the lift. Now the reverse is happening. Anything which is mid and small cap stocks, nobody is looking at balance sheet, valuations, earning, P multiple, bech do, because sab gir raha hai. When do you think logic will come back? When do you think market sanity will come back? Because 2017 again was insane on the greed side. This year it's insane on the fear side.
I think this. Absolutely. So I think you've identified the problem, and to that extent, yes, this is the year in which I would expect that the grain should be separated from the chaff, and you will probably see a lot more rationality. I think this is not going to be a year in which you can easily ride momentum. You have to be far more considerate about valuations, what you are paying for what kind of company. So that's where I said that the middle of the mid cap will probably do a little better. The upper and the middle of the mid cap will probably do better than probably the the lowest part of the mid cap. I mean, if you were to probably stack them in terms of quality of businesses, etc. So I think that gravitation will happen during the course of the year. During this year, I would certainly think that will be what will separate the men from the boys, so to speak. And it will be not just for mid caps, perhaps it will even be in the larger caps, and that is where the differentiation will lie, that you will be a lot more stocks selective in your approach. what one has to be careful about is this is like as I said, this is not a year where you can buy a lot of momentum trade and say that I'll buy something at 30p multiple and expect something to be easily sold out at 40-45p multiple. That's not going to happen as easily. You have to be a lot more reasonable in buying in the valuations that you pay, and that will probably allow you lesser downside, I mean a protection towards the downside, and probably allow you a certain degree of alpha even in this year.
Taher, I again want to go back to this entire debate of consumption versus cyclicals. Consumption is where valuations are not stretched, but you can be sure of reasonable growth. And frankly, the volume dispatch numbers which we've got from a Dabur or for that matter in HUL, they've surprised us. But on the other side, you've got cyclicals which are cheap, earnings are yet to pick up. Everybody is hoping that earnings will pick up, but that is not happening. So, what is a better strategy? Go for something where you know that there is visibility, or align with the hope trade because the margin of safety and valuations are stretched. It is like saying that is it better to have one hand in the one bird in the hand rather than two in the bush?
I think it's important to strike a balance between both of them. You can't really position yourself significantly heavily towards only growth oriented stories and then end up paying very heavy valuations for them as well. You have to balance your portfolio at one level. Yes, on the cyclical component side, you have to be careful about the quality of the companies that you buy. That is more important, and it'll probably be more important than the quality of the companies that you buy on the consumption side. I would think, because there the pain can be probably a little more, and your time horizon could be a little longer. So therefore, you don't really want to end up with a situation where even if cyclical recovery comes about, it bypasses the investments that you have. So as and when the cyclical recovery comes about, your investments need to be at the center of that cyclical recovery and benefit out of it. So you have to be lot more selective in that regard, in that space. So I think you don't have a choice as a portfolio manager but to balance both the legs of the story. And in the last 6 months, while the markets seem to be suggesting something else, and I have a feeling that in the shorter run sentiments are running way ahead of market realities, and to that extent, the ground level situation doesn't seem to be as bad as what is probably getting reflected in stocks, and therefore to that extent, it is still not a stage where you can completely dismiss the fact that cyclical recovery will not happen. We have built a few building blocks in the last year. We've put behind some of those issues like Demon GST behind us in the last 1 year. Even corporate 10p related issues are a lot of it has covered ground has been covered in that area in the last 1 or 2 years. So you can't bet against a cyclical recovery either in the next 1-2 years. It can still very well happen, and some of the building blocks for that are in place. So I think from a portfolio perspective, you have to have a certain amount of logical positioning there as well.
The key question is, we're all on the same page that you must buy the fear and sell the greed. So you know what really tactically you should be doing in the portfolios. But again, the universe of mid and small caps and the ones that have fallen is just so large. How is it that you now try and dissect what is it that you should be buying and what is it that you still should be staying away from? As a strategy, what do you think is going to work within mid and small caps?
Yeah, so I think at a broader level, even in the mid and small cap space, it appears to be exactly that same thing is panned out, in the sense that a lot more of the cyclical mid caps have kind of taken a bigger beating compared to the more consumption or non-cyclical mid cap, so to speak. So that same sentiment or the same approach is prevailing even within the mid cap space, and so I think again the same rule applies, that you have a combination of those both the sides of the story. You want to play consumption with a certain amount of reasonableness to valuations. You don't want to overpay there, and at the same time you also want to buy a few things which you believe have a fair chance of coming back. See, we've not been part of the global growth engine, global growth curve either in the last 1.5 years. Some part of it has been missed by us in this whole confusion on GST, etc. So I think we still have, it looks like a fairly decent global growth cycle even now to us, and therefore India should partake of that as well in the next 12-18 months, a lot more than what it has been able to do. So that growth opportunity is still available, and that should also reflect on some of the mid-cap opportunities in the market. So I think all is not lost. You have to kind of now differentiate. You will probably be able to, and market will differentiate over some time, maybe over the next 6 months probably, but it will differentiate between those where earnings delivery comes about versus those where earnings delivery is was misplaced in the first place in terms of assumptions.
Taher, so closing comments. For someone who's, let's say, buying equities at the current juncture and has a genuine 3-year view, should they expect double-digit returns? I'm not asking you for a commitment, but indication based on the fact that levels are low, we have a general election, and we are on cusp of an earnings recovery. If I put all these 3 factors together, do you think an average equity diversified scheme can potentially give double-digit returns, maybe early double-digit returns, but from here is a CAGR of 10% plus coming?
I wish I could assure returns, but the thing is that as you if you look at a 3-year cut, then let's say 2013 or a little before 2014, mid caps were not doing well. But even if you were to probably account for the carnage of the last 6 months, I think even mid cap oriented and small cap oriented products on a last 3.5 year basis have done reasonably well, and there have been returns on the table probably of the magnitude that you mentioned, above 10%. So I think that is still a reality, and that is exactly what can be possible when you buy them when they are in this kind of a bit of a tattered state. So it's better to go in for mid cap stories at a time when this is what it is, the reality, the way we are. Of course, you have to do your stock selection as well, but that gives you a better chance of hitting at that 12 or 15% kind of return number over a 3-year period, compared to probably getting it had you done it, let's say, at very, very excited periods over the last maybe 6 or 12 months time. So yes, I would agree that over a 3-year we still are in the fray for double-digit returns, and maybe even more than that. Beyond this 1 year where we see a little more volatility and we need to be a little more watchful of things, post that I think we should be on course to deliver that return picture.
Taher, always a pleasure to have you on ET Now. Thank you for joining us. Well, last trading day of the month, last one for the quarter, what otherwise has been a very dark quarter, so to speak.